For high net worth individuals and global nomads, Italy has long been a paradox. A country with an unparalleled quality of life, but a tax system that feels like navigating a labyrinth in the dark. However, since 2017, Italy has been aggressively competing for global talent and capital. While much of the buzz has been focused on the digital nomad visas or the 7% tax for retirees in the south, there is a far more powerful tool in the Italian arsenal, one that was specifically designed to mirror the UK's non-dom status. Originally introduced as the €100,000 lump sum payment, the substitute tax for new residents underwent a significant change in late 2024. The price of admission has doubled, but for the right individual, the value proposition remains one of the strongest in the European Union. Welcome to Taxplained, explaining taxes so you can minimize your burden and maximize your freedom. The core of this regime is simplicity. Instead of navigating Italy's progressive tax brackets, which peak at 43%, new residents pay a single fixed fee of €200,000 per year. This payment acts as a total substitute for income tax in Italy on all foreign-sourced income. Whether you earn €1 million or €100 million out of Italy, your liability to the Italian treasury for that income is capped at a flat fee. The substitute tax is not just an income tax to pay, it's a holistic wealth management strategy. Under this regime, you're also generally exempt from the Italian wealth taxes on foreign real estate and foreign financial assets, also some reporting requirements, the dreaded Quadro RW form, which usually requires residents to disclose every foreign asset they own, also the inheritance and gift tax on foreign assets, allowing for massive advantages in multi-generational estate planning. The duration of this golden ticket is 15 years. It provides a level of long-term tax certainty that's becoming increasingly rare in the world of shifting tax policies. The barrier to entry is not just financial, it's based partially on your history. To qualify, you must not have been a tax resident in Italy for at least 9 out of the 10 preceding years before your application. This makes the regime a one-shot opportunity for those moving to Italy for the first time or those who have been away for more than a decade. The definition of residency in Italy is strict. You are considered a resident if you spend more than 183 days in the country, but also if your center of vital interests, so your family, your main home, and your business headquarters, is located on Italian soil. One of the most attractive features for families is the extension clause. While the primary applicant pays €200,000, family members can be brought under the same protective umbrella for only an additional €25,000 per person. This applies to spouses, children, and even certain dependent relatives. For a family with multiple members holding significant foreign investments or trust distributions, the per capita tax savings can be staggering. Considering a move to Italy, if you have a complex global income profile and want to see if the €200,000 regime is the best path forward, then please reach out to our specialist team for a personalized assessment. No tax regime is perfect, and Italy's flat tax comes with specific boundaries that catch the unprepared. The most significant is the distinction between foreign-sourced and Italian-sourced income. If you move to Milan and start a local Italian company, the profits from that company are taxed at ordinary Italian rates. The flat tax does not cover income generated within the country. Furthermore, there is a cherry-picking rule regarding capital gains. If you sell a qualified shareholding, typically a large stake in a company, within the first 5 years of residency, that gain may be excluded from the flat tax and taxed at the standard rates. There's also the matter of the advanced tax ruling, interpello. While not strictly mandatory in every single case, it is the only way to get a binding confirmation from the Italian Revenue Agency that they agree with your status. Moving your life to a new country based on an assumption can be a risk, most high net worth individuals might not be willing to take. So why choose Italy over Portugal's NHR, which has been significantly scaled back, or Greece's lump sum program? The answer usually lies in the G7 status. Italy is a major global economy with a network of double taxation treaties. Unlike offshore tax havens, which can sometimes carry a stigma or face banking hurdles, Italy offers the prestige of a Tier 1 European jurisdiction. For those coming from the UK, the timing is particularly important. As the UK dismantles its non-dom regime, Italy has positioned itself as the natural successor. It offers the same remittance basis style of life, but with more sunshine and a 15-year guarantee. Success in this regime requires a three-step dance, if you will. First, you must secure the right visa, often the investor visa, the golden visa, or the elective residence visa. Second, you must establish physical and legal residency. Finally, you must make the election on your first tax return. The August 2024 price hike from 100k to 200k signals that Italy knows the value of what it's offering. The government is no longer looking for mass affluent residents, they are looking genuinely for ultra high net worth individuals who view Italy as their primary base. Ultimately, Italy's flat tax is more than a tax calculation. It's a trade. The Italian government receives a guaranteed high-value annual contribution with zero administrative overhead, and the taxpayer receives the freedom to manage a global empire from a villa in Tuscany or a penthouse in Rome without the taxman looking over their shoulder at every foreign dividend. Navigating cross-border moves requires a blend of legal precision and lifestyle strategy. Italy has opened its doors wider than ever before for those willing to pay for the privilege of simplicity. If you're ready to trade complexity for a flat fee, the Italian Dolce Vita is awaiting for you.